Welcome to this brief overview about debt, a very important area of personal and family financial management. My name is Catherine Solheim, and I will be talking about two types of debt, as well as some ratios that are important to understanding and managing household debt. Finally, I'll talk about what to do when debt is unmanageable. So let's begin. Thinking about the amount of debt can be overwhelming, but it is a necessary process in order to understand how much you owe. Some of the basic things to know when reviewing your debt include understanding what types of debt you have. There are two types, secured and unsecured debt. Secured debt is a type of debt that requires collateral. This means that some asset is backing up your debt. Examples of secured debt include cars and mortgage loans. If you are delinquent in making several car payments, the lender can repossess the car, which is the asset that has secured the loan. If mortgage payments are missed, the lender may foreclose on your home. Unsecured debt, in contrast, does not require collateral. One major source of unsecured debt is credit card debt. This type of debt typically has higher interest rates compared to secured debt. In the case of default on the debt, lenders will use collection agencies to try and recoup the balance of that debt. Let's talk a few minutes about ratios that will help you understand your debt level. Debt ratios help you understand the percentage of assets that are financed by debt. This is closely aligned with net worth statement. The formula used to calculate the debt ratio is to take your total debt and divide it by your total assets. To calculate this ratio, you would list and add the value of all of your assets. Remember, these are things you own. Then you would list and add up the value of your debts. Remember that those are things you owe. In this example, the total debt value is $154,500 and the total asset value is $206,000. If I divide $154,500 by $206,000, the answer is 74.7%. This means that 75% of the assets you own are financed by debt. Debt level depends on a person's or family's life cycle stage. It is typically higher when families are building assets, particularly if they have purchased a home. In the early years of a mortgage, there is little equity in the home, so it makes sense that one's debt ratio would be higher. Over time, however, that will decrease. The value or equity in the home increases, while the debt level goes down. Someone that is just graduating from college will have a higher debt ratio compared to someone who is about to retire. College students have invested in their human capital, which often involves taking on debt. However, they will have a lifetime of return on that investment in the form of income. So some level of debt makes sense. When evaluating debt, it's important to take life stage into account. A general recommendation is that a household's debt ratio should not exceed 30%, which means that 30% of your assets are financed by debt. In the example just presented, the debt ratio was 75%, primarily due to lower home equity and higher mortgage balance. Another thing to remember is that accumulating debt by using consumer credit for lifestyle expenses such as entertainment, gifts, vacations, will increase debt, but does not add to your asset column. So it's important to ask whether increasing debt to support lifestyle purchases is wise. Probably wiser to use credit to build your assets over time. Now it's time to look at monthly payments that go to pay debt. The debt payment ratio is the percentage of after-tax income used to pay required minimum payments on debt. The formula is total monthly debt payments divided by after-tax monthly income. So let's walk through an example. Let's say that the minimum monthly payments on credit cards are $150 for one card and $30 on the other, so a total of $180. Your car loan payment is $365, so your total monthly payments are $545. The gross monthly income is $3,000, which means that after tax, monthly income is roughly $2,300. 545 divided by 2,300 is 27%. Is this good or bad? Remember the 50-30-20 budget recommendation we talked about earlier? That suggests that 20% of one's budget should be dedicated to debt repayment. And remember, savings too. So a person at 27% is already beyond this recommended level for monthly debt payments. Plus, they are not likely to be saving anything. In this case, reduction of debt would be a high priority. The debt payment ratio is important because it has implications for regular cash flow. Too much income committed to repaying debt hampers families' abilities to meet other expenses. They may struggle to save for future goals, or they probably will not have money for emergency expenses should the need arise. So debt is one of the reasons people describe themselves as living paycheck to paycheck. The ratio is also used by lenders when they evaluate consumers' ability to take on additional debt. Lenders generally require that a potential borrower's debt payment ratio not exceed 33 to 38% of their gross income. Remember, gross income is before taxes are deducted. So it's important to keep that in mind, that this recommendation might not be comfortable for many consumers, primarily because it uses before tax income. When we calculated earlier, and the recommendation was less than 20%, we were using after-tax income. So you can see that they will say you can take on more debt than perhaps you're comfortable with. It's important to know that, because when you go into the bank, they may say, oh, you can take out a loan and have this minimum monthly payment or your installment payment at this level, when in fact it may be more than the consumer can handle. So if consumers are not careful, it's quite easy to take on more debt than they can effectively handle. Remember that debt or the use of credit means you are committing future income to pay for current expenses. What are some common mistakes people make in relation to their debt and debt payment ratios? Why do we fall into these traps? When you finish this presentation, please share your experiences and ideas via the discussion forum on Moodle. Based on the credit system in the U.S., reasonable debt and its responsible repayment are encouraged in order to build a credit history. Our country is built on credit. Although debt is encouraged, it should be used responsibly. So how does one determine if their debt is getting unmanageable? Well, one way that you might think is that when you're unable to make minimum monthly payments, when bills become past due, and the total amount owed keeps getting larger because all the fees that are incurred. Now, I will say that if you're unable to make minimum monthly payments, there's also issues here because you will not be paying down your debt in a reasonable way either. But that is one of the warning signs if you can't even make minimum monthly payments. So what happens is that this snowballs, and there might create a situation in which the person may have difficulty meeting even basic needs, such as for food and shelter. And sometimes bills are in collections. These consequences vary from situation to situation, but when it gets to the extreme, consumers might face foreclosure, eviction. When it is even not to the extreme, but they will be borrowing, they may incur higher interest rates. They may even have an inability to borrow. And for most that are in some kind of a relationship situation, there will be conflict within the family, perhaps because some people have different levels of comfort with debt, and most likely everyone will be under stress. So on average, 30% of one's income goes toward housing. As debt becomes unmanageable, housing tends to be impacted. The national foreclosure rate was 23% in April of 2013. When people are unable to pay their mortgages or rent, they may lose their homes or get evicted. When the debt starts to pile up, resources may be shifted and rent or mortgage goes unpaid. Another impact is that credit would be affected. Missing payments are reported to the credit reporting agencies, which results in lower credit scores. Foreclosures and evictions are also reported on credit scores. And remember that negative information remains on the credit history for an average of 7 years after the last date of activity. And also important to remember that a lower credit score diminishes one's borrowing ability. Depending on the level of debt, there may be restrictions to borrowing, or a co-signature may be needed on a loan. If you are able to borrow, interest rates will be higher, meaning over time the cost to borrow or the cost of the thing that you've purchased will be much greater. Additionally, the amount of the loan that you're able to secure might be lower as well. As debt builds up and borrowers struggle to make ends meet, stress increases. Additionally, lenders may use collection agencies to recuperate their losses, which causes more stress. In addition, unmanageable debt can lead to relationship conflict. In an earlier module, Shonda Kraft, couple and family therapist, discussed the role of money in couple relationships. Sometimes there's challenges even in good times, but when you add stress, when you add debt, when you add differences in comfort levels with debt, when blaming starts, when shaming starts, conflict can arise. Remember the color of money exercise you completed earlier in the course? You learned what money meant to you, so things like security, status, etc. But everyone in your family has a money color. If money is managed jointly in a family or household, it really can be helpful for all members to complete this color of money exercise to start talking about issues. Because remember, when you are then in a debt situation and stress arises, knowing what another person's color is might help you understand why they are reacting to the debt in the ways that they are. Here are a few websites that explain the concepts we just covered. Thank you for considering this very important aspect of financial management. You know, debt is perhaps the most difficult topic to tackle. It can be overwhelming if a person can't see their way out of it. People can feel shame if they've accumulated debt. They may think of that as a character flaw. Others may think that they have a character flaw. And we really don't know why that debt was accumulated. We only see the numbers. Perhaps there are things that are out of people's control. For example, medical bills, an emergency that they didn't anticipate. So it's important to address the underlying causes of the debt, but also the emotional aspects of debt. If the emotional factors are not addressed, it can be difficult to practically tackle a solution to decreasing debt. Tessa Eddy identifies the importance of building rapport and trust with families who are trying to manage their finances and may be experiencing unmanageable debt. After this presentation, please listen to her video and then please share your strategies that have been helpful with individuals and families when you're helping them face debt issues without shame or embarrassment. You'll find Tessa's video and the discussion forum on the Moodle site. Thank you for your attention, and I hope this information has been helpful.